It feels like the ground has vanished from beneath your feet. Just moments ago, you were watching your chosen stock ascend, a steady, beautiful climb that confirmed all your hopes. You felt smart, validated, even a little bit invincible. Then, in the span of a single hour, a violent shudder runs through the price. A long, menacing red bar appears on your screen, erasing the progress of the last 3 days. Your heart pounds. Your first instinct, born of 1,000 internet gurus, screams, "Buy the dip! It's on sale!" But a deeper, colder voice whispers a question that freezes you in place. If this is such a great buying opportunity, why does it feel like a trap? Why is the volume, the raw number of shares being traded, exploding to levels you haven't seen in months? This moment of conflict, this crossroads between greed and fear, is where most accounts suffer from catastrophic capital erosion. And it all hinges on understanding the story being told not just by the price, but by the force behind it. The mistake uninformed participants make is to view price in a vacuum. They see a lower number and equate it to a bargain, like finding a designer coat marked down at a department store. But the market is not a store. It is an auction. A dynamic, brutal auction driven by the rawest of human emotions, fear and greed, and governed by the immutable law of supply and demand. A pullback, a temporary decline in price during an uptrend, is a normal and healthy part of any advance. It's the market taking a breath. However, not all pullbacks are created equal. The key differentiator, the piece of information that separates the professional from the crowd, is volume. Volume is effort. Price movement is the result. This is the cornerstone of market analysis. When you see a small price dip on very light volume, what is the market telling you? It's saying there is very little effort, very little conviction behind the selling. The selling is passive, disorganized. It's like a gentle rain shower, not a hurricane. This is a low-volume pullback, and it is often a sign of strength. It suggests that the large operators, the smart money, are simply allowing the stock to drift lower to shake out weak hands. But they are not participating in the selling themselves. There is no urgency, no heavy supply hitting the market. A high-volume pullback is a completely different animal. It is a declaration of war. When the price falls sharply and the volume bar associated with that fall is a skyscraper, towering over all the recent activity, it signifies a massive coordinated effort. This isn't a gentle rain. This is a fire hose of supply being unleashed onto the market. The crowd sees the price drop and rushes in to buy the bargain. But who are they buying from? They are buying from the very institutions that were quietly buying at the lows and are now aggressively distributing or selling their shares at these higher prices. The high volume is the evidence of this massive transfer of stock from strong, informed hands to weak, emotional hands. The law of effort versus result is screaming a warning. An immense amount of effort, the high volume, has produced a negative result, a sharp price decline. This tells you, unequivocally, that supply is overwhelming demand at this price level. The sellers are more motivated, more aggressive, and more powerful than the buyers. To ignore this signal is to step in front of a speeding train because you believe the train is on sale. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original, timeless wisdom, presented in the annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Understanding the principles laid out in that work is the first step toward moving from a gambler to a speculator, from a participant to an analyst. It teaches you to stop asking what the price is doing and start asking why it is doing it. The high-volume pullback is a clear answer to the why. It's happening because large interests are selling, and you are being invited to be on the other side of their trade. Let's build a mental image of this event so you can recognize it without needing to see a screen. Picture a healthy, established uptrend. It looks like a series of waves climbing a beach. Each wave pushes a little higher and then recedes gently. The push forward, the price advance, happens with a good, solid surge of energy or volume. The recession, the pullback, is gentle and quiet, with very little energy or volume. The water calmly pulls back before the next, stronger wave pushes forward. This is the rhythm of a healthy market. Now imagine you are watching this beautiful rhythmic advance. Suddenly a rogue wave appears, but this wave is not moving forward. It is a massive undertow pulling everything back with incredible force. The price plummets, and the sound of this undertow, the volume, is a roar. It is louder and more powerful than any of the sounds of the advancing waves. It changes the entire character of the beach. The gentle rhythm is broken. This violent, loud recession is the high-volume pullback. It is a structural break. It tells you that the underlying forces have shifted. The placid buying has been met with ferocious, concentrated selling. Your job is not to swim against this undertow. Your job is to acknowledge its power, get out of the water, and wait to see if the storm passes or if it's the beginning of a tsunami. So how do we translate this understanding into a concrete plan of action? The first rule, and the most important, is to do nothing. When you see that giant red bar on skyscraper volume, your job is not to act, but to observe. You are a detective who has just discovered a major clue. You do not arrest the first person you see. You watch, you wait, you gather more evidence. The high-volume pullback is the clue. The market's subsequent action is the evidence that confirms or denies your suspicion. The suspicion is that supply has taken control and the uptrend is in jeopardy. The setup, therefore, is not the pullback itself, but the market's reaction to it. After this violent drop, what happens next? The most common and highest probability outcome is a weak rally attempt. The price will try to bounce. The crowd that bought the dip is feeling hopeful. But you will be watching the volume on this bounce. If the price drifts upward on volume that is significantly lower than the volume of the preceding drop, this is your second major clue. It's like an echo that is weaker than the original sound. The market is showing you it has no energy, no conviction to push higher. The buying demand is exhausted. This weak rally on low volume is the setup. It shows the market attempted to recover from the injury but failed. The trigger for action comes when this weak rally stalls and begins to roll over. Imagine the price climbing feebly back up, perhaps recovering 50% of the big red bar's drop, but on pathetic, anemic volume. It then stops. It prints a small bar, or a bar with a long upper wick, indicating sellers are re-emerging at this higher price. The moment the price then breaks below the low of that small rally bar, that is your trigger. For those in a long position, this is the final, undeniable signal to exit the trade and preserve capital. For an aggressive, experienced trader, this could be a trigger to initiate a short position betting on a further decline. The logic is airtight. The market showed overwhelming supply on the drop, then showed an absence of demand on the rally. The path of least resistance has now shifted from up to down. Protecting your capital is the foundation of this entire enterprise. If you initiate a short position on that trigger, your stop-loss placement is simple and logical. It must be placed just above the high of the weak rally. Why? Because your entire thesis is based on the idea that this rally was weak and would fail. If the price, against your expectations, manages to push above the high of that rally, your thesis is proven incorrect. The market is telling you something else is happening, perhaps absorption of supply, a complex scenario we can discuss later. By placing the stop there, you are letting the market, not your opinion, tell you when you are wrong. The loss will be small, defined, and intellectually honest. This is the practice of a professional. You are not betting the farm. You are making a calculated speculation based on evidence, with a predefined exit strategy in case the evidence was misleading. This removes emotion and replaces it with process. Now, what if the market doesn't follow this neat script? Markets are complex systems and they rarely behave in perfect textbook fashion. One common variation is the whipsaw. The price drops on high volume, rallies weakly, triggers your short entry, and then, just to inflict maximum pain, it screams upward, stopping you out before collapsing again. This is incredibly frustrating. It can make you feel like the market is personally targeting you, but it is not. This is often the result of large operators engineering one final shakeout to dislodge any short sellers who correctly identified the weakness before they allow the price to fall. The lesson here is not that your analysis was wrong, but that risk management is everything. You took a small managed loss. The alternative, not using a stop loss, would have resulted in a significant drawdown. After being stopped out, you do not engage in revenge trading. You step back, observe, and if the bearish structure sets up again at a higher price, you can re-engage with the same disciplined process. The market rewards patience, not anger. Another, rarer scenario is what happens if the high-volume pullback does not lead to a further decline. What if the price drops violently but then stabilizes? Imagine that huge red bar forms, but the next several bars are very narrow, with price moving sideways in a tight range right near the lows of the drop. The volume might decrease significantly during this sideways movement. This could be a sign of absorption. This is a far more complex and subtle event. It means that a powerful financial interest used the panic selling, which they may have initiated, as an opportunity to absorb a huge number of shares without pushing the price back up immediately. They are like a giant sponge quietly soaking up all the supply. The sign that absorption has been successful is a subsequent powerful price move back up, usually on high volume, that breaks above the high of the initial drop. For a novice, this pattern is best observed, not traded. It's a battle of titans, and it's easy to get crushed in the crossfire. The primary, most reliable interpretation of a high-volume pullback remains a warning of weakness. Treat it as a red flag until the market proves with overwhelming force that it was something else. Ultimately, the interpretation of a high-volume pullback comes down to a fundamental shift in perspective. The uninformed trader asks, "How low will it go so I can buy?" This is a question rooted in hope and a desire for a bargain. The professional analyst asks, "Why did this happen, and what does the market's reaction to it tell me about the balance of supply and demand?" This question is rooted in logic and a search for evidence. The price drop itself is just noise, the volume gives it context. The subsequent rally, or lack thereof, gives it meaning. By combining these three elements, the event, the context, and the reaction, you move beyond simple pattern recognition and into the realm of true market analysis. You stop gambling on price and start speculating on probabilities based on the market's own revealed behavior. The core lesson is that the market communicates its intentions. It does so not through news headlines or expert opinions, but through the raw data of price and volume. A high-volume pullback is one of the clearest messages the market can send. It is a loud, unambiguous statement that the character of the trend is changing. It is a warning that the forces of supply are now active, aggressive, and potentially in control. Your duty as a disciplined speculator is to respect that message. Do not argue with it. Do not hope it away. Listen to it. Analyze the market's response and align your actions with the evidence. This path requires patience, objectivity, and a deep respect for risk. But it is the only path that leads to long-term survival and success in the markets. If you want to understand more about the subtle language of the market and how to interpret its messages, stay with us. The journey of learning is lifelong, and each piece of knowledge is a step toward mastery.